You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributor to Backroom Technician. This week on The Biz, Income Tax Planning Series for 2013, and on today's show, our introduction into income taxes with national columnist, certified financial planner, and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And all this week, we're going to have Ken Davis with us to talk about our income tax planning for this year, 2013. Well, welcome to the show, Ken.
Hey, Steve.
Well, it's that time again. It's tax time, and I have to say, I have to go back to the beginning of the United States. One of the premises of taxation was there should be no taxation unless we have representation. So we have that. And so if we have a gripe about what we're paying, we need to talk to our representative and say, hey, you need to either trim it down or we're okay with it.
That's exactly correct. We have a responsibility to communicate with our congressmen and to vote our conscience on what we think is correct.
Well, when I think about it, we're looking somewhere around $17 trillion in debt right now. And if I divide that up against every American's probably going to owe maybe around $54,000. But not all Americans pay federal debt, federal taxes. So the people that do pay, which is only about 53%, really pay, if they had the bill put to them today, we'd have to write a check for about $150,000 each.
Yeah.
Now, that's a lot of money.
And you can even argue that it's more than just what's on the books, because Congress is quite good, adept at hiding things like there are unstated liabilities for future promises and social benefits that have not been put on that balance sheet of $17 trillion.
When you think about it, if you go out to the website, truthinaccounting.org, you'll hear exactly what Ken's talking about, because it not only includes the U.S. debt at almost 17 trillion, but also all of our obligations, pensions, Social Security, everything all in, and it hits about $72 trillion.
You know, as we talk about this, it sounds so negative, and it is negative. However, I got thinking back, there have been presidents, and I don't want to get political, so I'm not going to name names, but there are presidents who have taken an attitude of we can grow ourselves out of the problem, where we can ignite the economy and can have a positive message, of can-do message that the Americans can rise to the occasion, and that message resonated. In fact, I can think of both Democratic and Republican presidents that have had a positive message that have stimulated people to take action and to grow. And I think, as opposed to focusing on raising taxes or how awful things are, if we can focus on getting America going again and providing jobs and increasing revenue so that we actually have the money to pay for that debt, that's really the positive way out of this process.
Well, when I think about it, last year we celebrated Tax Freedom Day. You know, that was April 17th. But because of the new taxes and all the new laws that are on the books now, we may break the year 2000's actual date of May 1. Wow. Now think about that. They're still calculating it. We can't even tell you what it is today. That's how bad it is. So sometime in May, we may actually have our Celebrate Tax Freedom Day. That's the time where we now start working for ourselves. We paid all of our taxes. But when you think about it, if we're pushing into May, and I laugh because people say, well, Steve, you're not as bad as Europe because Belgium is in August. Now I want you to just think about that. Some of the European nations are well into the summer that their tax bills are paid, somewhere around July or August, when they can start working for themselves.
Well, that's like saying, well, gosh, I went to Dillard's and got a purse for this amount, and I went to Gucci and it took me this many months to pay for my Gucci bag. It's like, you know, do I really need a Gucci bag? And that's part of the question of what we have to ask is, yeah, we need government. We have very legitimate uses for government, and we need to pay for that. The question is how much government, and when is enough, and when are we paying Rolls-Royce types of taxes and costs for the services and benefits our government provides us? It's really a cost-benefit type of analysis. So it's not that we're just don't believe in government or taxes and whatever. It's how much is appropriate and what are we really getting in return as American citizen?
Well, think about it. There's going to be a time where the taxation, if it gets too high, it will actually become counterproductive to the country.
Well, yeah, it's interesting. A Nobel Prize-winning economist, Arthur Laffer, developed what's called the Laffer curve, and it basically says we know on the curve, if we have a 0% tax rate, we have zero taxes. If we have a 100% tax rate, we have zero taxes too, because who works for free? Somewhere in between there, and on that curve is this maximum amount where as you raise taxes, people say, I'm not going to work anymore, or I'm going to leave the country, or I'm going to do a cash-based business and not report it. I mean, there's a variety of different ways that people respond to excessive taxation, and unfortunately, we don't actually increase the revenues. What happens, they actually decrease, which is counterintuitive, but it actually works that way.
When you think about it, we could be turning into the barter nation. I mean, it's already happening, kind of an underground economy by itself. Now, Ken, when we're talking about it, we want to prepare for this. Now, remember, there's a lot of rules of engagement when we're doing our 1040, when we're filing our taxes. When we come back on the second break, we're going to walk through the big three. But just as a kind of a, before we close out, when you think about taxation, and talking about to a professional about this, you think this is really necessary? I've heard you say this many times. We got to talk to a person that knows what they're doing.
Well, that's exactly right. I mean, there's no way. There was a time when I started in this business where if a client called me up when I was working at a big 8 accounting firm and said, gee, I'm going to do this, what's that going to do to my taxes? Well, I could fairly quickly off the cuff tell them, well, it's going to cost you so much. Well, today, because of various deductions, credits, exemptions, inclusions of certain income like Social Security, alternative minimum tax, all these different machinations the code has, it's truly impossible to know what the bottom line is unless you use a sophisticated tax program, and that's what a tax advisor can do for you.
When we come back from the break, we'll continue our introduction into taxes, part of our income tax planning for 2013 with Ken Davis. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's materials at thebiz.tv. And while you're there, click on the background technician icon for a 30-day free trial offer for access to the best needs analysis and client education material that address almost every financial scenario. I've been using it for almost 22 years. And remember, before moving forward with any of the ideas on the show, always consult your tax advisor and broker-dealer compliance department before moving forward. Of course, I'm with Ken Davis, CLU, CHFC, CFP, and hey, CPA, the reason you're here. Ken, we talked about in the first part, why are we taxed, some of the things that our country is up against, some of the challenges. But let's talk about the big three things that most American taxpayers are faced. They can use tax exemptions, they can use tax deductions, and they can use tax credits. They're different, and I want to be able to kind of make a description for each category so that we can understand what we have, because there's rules of engagement here. So let's talk about the first one, my favorite, tax exemptions.
Well, tax exemptions are things that are given to all Americans, like you get one exemption for each taxpayer. Then you also have exemptions for dependents, and there are different examples throughout the code. But basically, they are a deduction against our income to determine how much tax we pay.
So if let's say, for example, the typical one is a married couple, 2 children. So they're each going to get a standard deduction. I think this year is like somewhere around 37, 38.
Okay, we just switched from exemptions to standard deduction.
I was testing you, Ken, just to see. Okay. Let's talk about, when I'm talking about exemptions for myself.
Yes.
Exemption for my spouse.
Right.
Exemption for my children.
Yep.
Is there any other exemptions that I'm looking at besides those four?
Well, there's one I believe, and quite frankly, I don't prepare taxes anymore, so it doesn't immediately jump to mind, but I believe for blindness, age 65, stuff like that.
So if you maybe had a relative or you were yourself, there'd be another possibility. Okay. So people that have, I guess that gives the right, if you have a big family, this is a pretty good idea. And I remember early on when my eldest son came back from school, he basically found out about the exemption that I had for his life, and he asked me how much that I owed him, and I told his mom to bill him for everything that he's been doing for the last 18 years.
Another funny thing was we used to tease the tax CPAs. I mean, this is nerds in action, right? We used to tease them if their children came like in January. Well, my son was born on January 28th, and that's a bad thing. You're supposed to plan when you have children to be like December 31st of the year because it applies for that year's tax return. So I was too late in terms of having my child delivered.
Wow, so a little early planning on conception could really make a difference.
Well, there you go.
Wow. Well, think about, okay, so we're talking about exemptions. Now, when we move into deductions, this is really the heart of it, and there's a lot of debate right now on deductions, especially the mortgage interest deduction. Talk a little bit about some of the major deductions looking into a 1040.
Well, and let's talk even on a little higher level. The fact is the way tax returns work out is you have your first page and your second page. And on the first page, you have your gross income minus business-oriented deductions, things like IRAs and other kinds of things. Self-employed people can take their health insurance deductions, what they call above the line. Well, the line is adjusted gross income on the bottom of the page. Why do I bring that up? Because a whole lot of deductions, exemptions, credits are phased out or increased based on what your adjusted gross income is. Well, you want AGI as low as you can get it, so having an above-the-line deduction is more valuable than a below-the-line deduction. Below the line is page 2, and is where we have itemized deductions. So I think when people think of deductions, they do think of IRAs, but they also think more of mortgage and interest, interest on your mortgage and taxes, property taxes, et cetera, medical expenses, casualty losses, various types of things. Those are below the line. And so they don't affect adjusted gross income. So they're less powerful than deductions that are above the line. So if you want to get some sense of your planning and you don't fully understand the tax law, just pull out, go to www.irs.gov and get a copy of the 1040 and just start looking at the line items and see where deductions flow in the tax return. And you can just say as a general rule, deductions above the line are more valuable than deductions below the line.
Well, I think that's really helpful, and especially when you think about, I never thought about IRAs being like a business idea or a deduction. But that's really a great idea to think about your first page. Those are the most valuable. Now, the last one we're talking about, this is a little strange because I always thought tax credits were solely and 100% if you owed taxes, you get a credit. But some people more in the poverty areas and so forth, they also get credits, and they could actually get money back from the government. So talk about those two different types of tax credits.
Well, first of all, let's talk about a tax credit versus a deduction. If I have $1 in tax credits, okay, that means no matter what my tax rate is, I come up with my tax bill, I get to subtract $1 against the taxes. Deductions, on the other hand, are dependent on what your tax bracket is. If I've got a 25% tax bracket and I have a $1 deduction, I only reduce my taxes by 25 cents, not $1. So first of all, credits are much more valuable than deductions are. So you look for those opportunities, and again, look at the tax return and the instructions. You'll find where those things are. What you're talking about is a refundable versus a non-refundable tax credit. Refundable means that you may have zero taxes due, and you're going to get a refund of those refundable credits, whereas a non-refundable credit are unused.
I like the idea of tax credits. In fact, actually, when you're buying a new home, and I'm looking for my retirement home right now, I'm looking at all the tax credits for fixing up your home. They're all over the board. So you're saying, wow, that's dollar for dollar, whereas a deduction is only whatever your marginal tax bracket is and that number.
That is correct.
To me, that's huge. And remember, you can watch all our shows by going out to our website, thebiz.tv, and follow me on Twitter, Facebook, LinkedIn, Pinterest, and Google+. Well, that's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.